All right, let's talk about one of the most misunderstood but most powerful tools on your chart, the volume indicator. In this explainer, we're going to break it all down, bust the biggest myths you've probably heard, and give you a real tactical guide on how to actually use it to make better trades. Let's dive in. Does this sound familiar? You see those colorful little bars at the bottom of your TradingView chart, and they're probably important, but what are they really saying? Look, if that's you, you are definitely not alone, but by the end of this, you're going to see volume in a whole new light. Okay, first things first, before we can even start to use volume as a weapon, we've got to clear the decks. We have to unlearn some of the junk that trips up, I'd say, 99% of traders out there. So, this is the big one, right? This is myth number one. You see a huge green volume bar spike up and you think, wow, look at all those buyers jumping in. Or you see a big, scary red one and you think, oh no, everybody's dumping their bags. But is that really what's happening? The answer, in a word, is no. Absolutely not. And yeah, that might be a bit of a shock, but internalizing this one simple fact is the most critical step you can take right now to understanding volume. Here's the real deal. The color of the volume bar is just for looks. It's window dressing. All it does is match the color of the price candle right above it. So if the price ticked up in that minute, the candle is green, and so the volume bar is green. It tells you nothing about whether there were more market buys or market sells. It's just a visual shortcut. That's it. So to really get this, we have to quickly go over two types of orders. First, you have limit orders. Think of these as vendors setting up stalls at a farmer's market. They're just sitting there waiting patiently for a customer. They are providing liquidity. Then you have market orders. These are the shoppers who sprint into the market and yell, "I'll take it, whatever the price is." They are aggressively taking that liquidity. This difference is absolutely crucial. And that brings us to the real definition of volume. The volume indicator only counts the aggressive people, the market orders, the takers. It's the total sum of all market buys plus all market sells within that candle. Those patient limit orders waiting on the books, they don't get counted at all. So what is volume? Volume is a measure of pure raw aggression. So now we know what volume actually is, but to understand why it's so important, we need to totally reframe how we look at the market. You gotta stop thinking about it as just charts and numbers and start seeing it for what it is, a game. Now, this isn't a game like building a business where new value can be created and everybody can win. No, trading is a zero-sum game. The best analogy is a poker game. The casino isn't printing more chips. The money just moves from one player's stack to another. For you to win $1, someone else at the table has to lose $1. Wealth is just transferred here, not created. So who is sitting at this poker table? Well, you've got the house, the exchanges. They just want you to play a lot so they can collect their fees. Then you have the professional card counters, the delta neutral traders. These are market makers. They don't really care if the price goes up or down. They just make money on tiny spreads. And then there's you. You are a delta 1 or a directional trader. You are making a bet that the price is going to go in one specific direction. This might sound a little harsh, but it's the absolute cold, hard truth of this game you're playing. Your profit and loss, your P&L, is a direct result of someone else on the other side of your trade being wrong. You get paid when other traders make a mistake, get trapped, or are forced to liquidate. That's the game. Okay, enough theory. Let's make this real. Let's get tactical. Now that we understand the game, how do we use this knowledge of volume to stop being the one who makes the mistake? It all starts with one incredibly simple but powerful filter. The single biggest and most common mistake a trader can make is playing in a game with no other players. When you trade a low-volume, illiquid coin, it's like trying to trade in an empty room. There's nobody there to take the other side of your trade easily, so you get a terrible price both when you buy and when you sell. We call that slippage, and it is a silent account killer. You just get stuck. So how do we avoid these empty rooms? How do we stay out of trouble? It's simple. You just have to remember this one number, $100,000. This number is your shield. It's your first line of defense against making a bad trade. So here it is, the filter, in 3 dead simple steps. 1. Switch your indicator to vol USD, because we care about the dollar value being moved, not just the number of coins. 2. The average volume on the 1-minute chart over the last hour has to be more than $100,000. If it's not, you don't even look at it. And 3, your own position size should never be more than half of that number. This just makes sure you can get in and out without moving the market against yourself. And here's what that looks like in the wild. On the left, you see a healthy, liquid, tradable coin. The volume is consistently above our 100K line. That's a game you can play. On the right, you see an illiquid ghost town. The volume is pathetic. That's not a trading opportunity. That is a trap. You just stay away, period.
Okay, so we've got our safety filter on. We're only playing in healthy markets. Now we can get to the really fun part, the advanced stuff. This is where we learn to read the story that volume and price action are telling us together. It's how we can start to anticipate what might happen next.
Think about it. When price moves to a really key level, like a major resistance, you can basically make one of two bets. You can bet that it's going to smash right through and keep running. That's a momentum trade. Or you can bet it's going to get rejected and reverse. That's a mean reversion trade. Volume gives us a massive clue about which bet is more likely to pay off. And this table right here, this is your cheat sheet. It's that simple. When you see volume increasing as price approaches a level, think of it like fuel being poured on a fire. It shows conviction. That's fantastic for a breakout, for a momentum trade. But if you see volume drying up and getting flat or decreasing, that's a sign of exhaustion. The move is running out of gas. That is the perfect setup for a reversal, a mean reversion trade. The key is, what's good for one is terrible for the other. And this leads us to the real nuance, the secret sauce. You can't just think in black and white terms like, is volume increasing? Yes or no? The real question is, how fast is it increasing? What's the intensity? A gentle little slope in volume is one thing, but an explosive, vertical, parabolic rise in volume, that signals a move with incredible power and conviction behind it. The intensity tells you the real story.
So at the end of the day, that's what volume really is. It's footprints. It lets you see the footprints of all the other players in this big zero-sum game. You can see their conviction, you can see their aggression, and you can see when they're getting exhausted. And once you learn how to read those signs, you stop guessing. You start anticipating. And the question is no longer, what is the price going to do? It's, now that I see their footprints, where are the other players going to be forced to go next?